Welcome everyone. Welcome to this episode of Market Wrap. I have with me Mr. Pankaj Pandey, and this was a interesting week, primarily because market went up, down, and it looked like it's going somewhere, but it eventually looks like did not. So, what is the outlook from here on? What does the market look like?
Yeah, hi, good evening, Vishu. Yes, this week has been a bit volatile and largely to do with the global factors. We've seen US 30-year bond yields crossing 5%. That is again largely because of the fact that a new tax bill is expected there, and which has really spooked the fiscal health of, or which is anticipated to sort of impact the overall fiscal health of US. And that sort of caused volatility. But what we have also seen is that at lower levels, when the correction happened, there has been support. Uh, Eventually, we ended marginally lower at about 0.5%, but broader markets did relatively well with a growth. Or say, for example, a small cap index was up about 0.5%. So some of the sectors like say realty, PSUs, I think they did well. And I think this volatility is again to sort of likely to persist even for next week as well, because you have a monthly expiry. The other factor is that overall global volatility can still sort of come in. We are still seeing volatility in FI flows. But overall sense is that for the next week, support could be somewhere about 24,200 to 24,400 kind of a level. And resistance would be about 25,100 kind of a level. But in this entire volatility, what I would also like to sort of highlight is that we are seeing mid caps and small caps are resuming their uptrend after they've been sort of consolidating post April, and they are still down or 7% and 11% away from their previous highs. So our sense is that the broader markets will keep doing relatively better. And since we are at the fag end of the results, you'll have some stock specific reaction because of that. But I think globally, again, we need to sort of watch out for the dollar index looking particularly weak. Possibility of a breakdown exists. Similarly, Brent crude oil also is sort of on a weaker side. And then I think any development on the bilateral trade between India and US again will be a key factor to sort of watch out for.
Absolutely. There were a number of results this week, lots and lots of results. So, let's start with ITC maybe.
Oh, yes. So it's been a busy week from a result perspective. ITC number largely is the replica of what happened in Q3. So revenues had gone up by about 10 odd percent. And again, cigarette business did about 6% kind of a growth. It is the agri business which continues to do pretty well with a growth of about 18 odd percent. Cigarette volume growth is about 5%, largely in line with the street expectation. And non-cigarette business or the FMCG business did not do so great. Overall growth rate was lower than what was anticipated. Now, overall sense is that the company is going to deliver a similar kind of a number in next 1 or 2 quarters. I think what could happen is somewhere down the line, 1 or 2 quarters down the line, there is the possibility of margin recovery, because in this particular quarter we have seen margins getting impacted in a segment like say for example cigarettes and all of it. So sense is that some recovery in the margins can be expected in the second half. Why we still like this stock is that of all the FMCG companies, this stock is trading at about 22 times. So relatively looks a better pick or stable stock compared to the other pack.
Absolutely. How about IndusInd Bank, sir?
Oh yes, bit of a shocker in terms of the losses because company posted or the bank posted a loss of about 2,300 odd crores. What they have done is that so overall performance was significantly weak. They've taken the full impact of derivative loss, accounting adjustments, and the elevated stress what they're experiencing in the microfinance book. Advances actually declined. YOY it's flat, largely because the corporate book did not grow. Deposit side, they did well, so it was a relatively flat. Margins again shrunk because of the slippages and also one-offs. So overall sense is that bank is going to experience weaker set of numbers for some quarters. But I think most of the pain is largely there in the books. So credit cost is something which we expect to sort of remain elevated because the MFI stress is going to be there. But I think why we are liking IndusInd Bank is that one overall sense is that you'll have leadership in place. Probably we'll know the name in the next 1 or 2 months. So fresh leadership remains the key for driving that strategic reset. Valuation wise, it's about zero point 0.6, zero point 0.7 times book. And I think for a private sector bank, achieving a ROA of 1% is not a big challenge. So all they require is a good manager. Once the good manager is on board, our sense is that you'll see recovery in the prices, and which is why we didn't see the kind of a sharper negative when the results got announced.
Right, right. Power Grid also came up with results this week.
So I think Vishu, lot of focus is on the generation companies, but I think somewhere down the line, people are ignoring the distribution side. You can't really have a generation happening without a commensurate improvement in the outlook for on the distribution side. Now, Power Grid number-wise was a muted quarter because revenues declined 5%, EBITDA again declined about 9.3 odd percent. Then largely because there has been delay in land acquisition, then supply. There has been transformer challenges. Companies not getting sufficient transformers, and there is a lack of skilled laborers as well. So all that sort of impacted. But I wanted to highlight, the transmission side or T&D side requires a capex of nearly 9 lakh crores by 2030. And Power Grid in this particular quarter gave a glimpse of that. So, for example, in this year, they've won orders worth about 92,000 odd crores. And the order book is in hand is somewhere about 1.5 lakh crores. What they're highlighting is that next few years, there is a bid pipeline of 3 lakh crores. And Power Grid has got a good win ratio. So even if they win 50% of it, you see a significant order inflows in the next 2 3 years. And which is why on the capex side, the capex has been inching up for this company. So they've revised their capex guidance from say 15,000 to 26,000 for FY25, which has already happened. And next 3 years, it's 30,000 odd crores, 35,000 odd crores, and 45,000 odd crores is the kind of capex what we're looking, and which is why we like this stock, and which is why we recommend this stock to sort of buy at current levels. I think more than generation, I think the focus also needs to shift on the distribution side.
Right, right, sir. I think on the real estate side, DLF has also announced some impressive numbers.
Oh yes, I think DLF continues to sort of do well. Their pre-sales booking was quite good. So what they have done is that they have achieved overall pre-sales of nearly 21,000 odd crores in FY25, which is up about 44 odd percent. And they're guiding for 20 to 22,000 kind of a number even next year. A good part is that their launch pipeline is pretty strong, about 95,000 odd crores, and of which 21,000 crores is the unsold inventory, which is sort of already launched. So our sense is they will keep to sort of do well on the residential side. A good part also is that on the commercial side, they are sort of doing very well. So they are developing about 28 million square feet. 6 million square feet is expected to come in FY26, and which will fetch them a rental of nearly 6,700 odd crores. What they are aspiring for is a rental income of somewhere about 10,000 odd crores. And for their looking to do a capex of 5,000 crore on an annual basis for FY26 and FY27. And stock is trading below NAV, so which is why we like this stock with a target price of 1,000.
Right. I think a number of players in the pharma sector also announced their results. What does the picture look like?
So largely similar set of numbers, Vishu, because we've seen numbers of Sun, we have seen numbers of Zydus, we've seen numbers of Torrent. And now if you look at all three companies have got presence domestically. So Sun is growing their domestic portfolio at about 14 odd percent. Similarly, when you look at Torrent, for them, domestic growth is 12%. Zydus also 12% kind of a growth. Now, the growth in the US is also largely on the similar lines. So, for example, Zydus has grown their US revenues at about 24 odd percent. Similarly, Torrent is not a big exporter, so their growth in the US is about 15 odd percent. And Sun, so growth is about 9 odd percent. But good part is that their specialty portfolio is nearly 20% of their overall top line. So overall sense is that all three companies are guiding for better than the industry growth in the domestic market. Plus, for the US market, they've got products in the pipeline, so which is where they're looking to sort of maintain or sustain these numbers. And none of them are guiding for big challenge in terms of they being forced to sort of do local manufacturing there, except for one particular product which Sun has. So all in all, all three companies are looking to sort of deliver consistent set of high digit kind of a number. Sun, we were slightly disappointed because the company is guiding for high single digit kind of a growth rate. And mind you, this company is already sitting on a $3 billion kind of a cash. So obviously their ability to sort of drive growth is quite higher through organic and inorganic means. But our sense is that they'll be able to do better than that. So which is why we're liking all three companies and we have a buy on all three of them.
Right. Right. I think next up we have defense sector, which has nothing short of skyrocketed. We had BEL and solar industries coming up with results. How did they look like, sir?
So I think defense companies continue to sort of look good. I wish they were available at cheaper valuations, which is what you sort of wish when the stock sort of does well. Now, coming to Bharat Electronics did numbers on expected lines, a revenue growth of 17 odd percent, which was in line with the provision numbers. I think margin wise, they did better. They were guiding for 25%, did nearly 29%. Now, for next year, what they're guiding is that, so this year they were guiding for about 25,000 crore kind of a top line of kind of order inflow. For next year, they are guiding for at least 27,000 crore kind of a order inflow. And on top of it, there is an expectation of 30,000 crore worth of QR, SAM project or the order which can get placed. So even if you sort of exclude all of this, they are sitting on nearly 70,000 crore kind of order book. I think this is one of the few companies in the defense side which has always displayed very stable set of numbers, and which is why we expect that even next 2 years they're going to maintain a similar growth rate and a similar margin, and which is why we continue to like the stock with a target price of 430. Now, solar industry is shaping up very well because see, when you understand this company, what we are clearly seeing is that the growth rate this year was 24%. Now, again, in the growth side, if you look at the defense segment, which is 20% of their revenues, and there the company is guiding for nearly 40% kind of a growth in the next 4 5 years. And margin profile for the company has done well. Their export revenues are also sort of doing well. They have increased the capex guidance overall, and what they're guiding is a 10,000 crore kind of a revenue in FY26, which again means that they'll be sort of doing even better growth in FY26 with a growth rate of about 32 odd percent. This stock is one of the most expensive stock, but again, overall senses with the kind of growth rates it commands or it is delivering, it is always commanding more than 2 times a book from a big perspective.
Right, right, sir. I think Dixon Technologies also raised some eyebrows in the market this week. What happened there?
So yes, on the result day, there was some negative reaction, but we continue to sort of like this stock because our sense is that when you look at the numbers for Q4, YY, the turnover has doubled. Largely what is doing well for them is the mobile and the EMS segment. LED TV is something which is sort of a bit sluggish. Margin profile has improved to about 4.3 odd percent. Now, going forward, the sense is that mobile, which forms their 75% of their revenues, they're going to do well there. So they produce somewhere about 2.8 or 28.3 million volumes, and which is expected to go up to 60, 65 in the next 2 years. And I think also the company is looking to sort of do more of value addition there, and which is where I think the overall sense is that the margin profile could improve. So, for example, display module is expected to start kicking in from second half of next year. Similarly, then they are working on camera modules or lithium-ion batteries and other stuff. So overall sense is that with the valuation they are looking at, the margin profile is also sort of expected to improve. And which is why I feel that a 40% kind of a revenue growth rate looks quite good to us. Return ratios are good at 25%. We have put a target price of about 20,000 on the stock.
Right, right. Next up for you, Gokaldas Exports.
So we haven't spoken about much about textile stocks, so I thought I'll sort of speak a bit. So Gokaldas is again one of the prominent exporters. Company did very well, 25% kind of a revenue growth, driven by 19% growth in volumes and 5% growth in realization. So obviously, FY25 numbers have been good. Now, what the company is saying for the next 2 quarters is that, see, we are already witnessing a reciprocal tariff of about 10 odd percent, which means that probably there will be some pressure on the EBITDA, on the margins. So EBITDA margins are expected to be a bit lower because they'll have to absorb some of this tariff. But what they're clearly saying is that from the second half onwards, things are going to look better, and which is why, while they did margins of nearly 10 odd percent in this particular year, they are guiding for a margin profile of about 12% over the next 2 years. And I think overall sense is that the FTA with UK is also going to be signed. So that is also going to provide a good opportunity for them of nearly $1 billion. So all in all, this company looks good to us. I think the prospects are for these companies or textile companies is getting better. So there could be some bit of a margin pressure in 1 or 2 quarters. But since the stock has corrected about 11 odd percent, any further weakness is a good opportunity to buy. We like this stock at current levels.
Right, right, sir. How about Hindalco?
So metals, again, Hindalco, one of the highest revenues they have done. Highest revenues for the quarter, nearly about 9,600 odd crores, largely anchored by Indian operations, because Indian operations EBITDA grew nearly 56 odd percent. And again, this is because of the fact that the aluminum prices were at a record high. Even the downstream products also did well. These spreads there were about $250 per ton. Good part is that they are expanding the value-added downstream operation from 4 lakh ton to 6 lakh ton. And so there, the margin profile is expected to get better. Novelis was stable. We had spoken earlier also. What they're guiding is again $600 per ton kind of EBITDA going forward. So nothing changes for Novelis. I think what we are liking about this stock is that the valuations are still quite attractive. And also debt equity side, it's at about 0.5. So which is why we like this stock largely because of attractive valuation, low leverage, and plus I think the capex is moving in the right direction.
Right. And finally, it's time for the hidden gem of the week. Which will it be this time?
So I'll recommend a name which I've never recommended. It's Vedanta with a target price of 600, so upside of nearly 35, 36 odd percent. Reason for liking is that next 2 years we expect the dividend largely to be sort of maintained. So it offers an attractive dividend yield of 9%. Now coming to some of the numbers, we all know that it's a conglomerate having presence in aluminum, zinc, lead, silver, oil and gas, iron ore, steel. Now, why we are liking this stock is that company is doing expansion in the aluminum division. So what they're looking to do is that they're expanding the smelting capacity from 2.5 to 3.1 million tons. And as a backward integration, they're expanding their alumina refinery to 6 million tons. And on top of it, they're largely secured through bauxite and coal mines. So aluminum operations are going to be back-ended, and that is where the bulk of the earnings growth is expected to come from. Hindustan Zinc, where they hold about 63% odd stake, is going to do a sort of a stable business, though they are also expanding capacity, but that is still some time away. And then I think the power and the steel businesses, other businesses which are expected to sort of do well. Our sense is that at this point in time, all the businesses are there, and the company is looking to sort of demerge the entire business into 5 new businesses to sort of unlock value potential. So reason for liking this is that overall, while we might not really be seeing a very great top line growth, but I think somewhere down the line, the overall improvement in the bottom line because of margin profile expansion is going to be significantly higher, and which is why we are expecting about 20% kind of a growth in bottom line. So bottom line could improve from nearly 15,000 odd crores to 21,000 odd crores, largely to do with the fact that the EBITDA per ton for the aluminum business is going to sort of go up. And along with that, it offers a good dividend yield. So I think this is the right time to sort of pick a stock like this with attractive dividend yield as well.
Absolutely. Well, that was it for this time. Thank you so much, Pankaj sir, for sharing your insights. And thank you so much, everyone, for watching. We'll be back next time. Until then, if you have any questions, please put them down in the comments. Thanks again for watching.
Thanks so much.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.